Hi everybody. So two big events for the week coming up. That's the European Central Bank rate decision and non-farm payrolls from the US. The backdrop to all of this in markets is that we've got falling equity prices as well as rallying bonds. So that's falling bond yields. Different to recent market corrections that we've seen that have seen both stock prices and bond prices falling together. This time around, very much seeking out havens in US Treasuries and shying away from equities, particularly those in the US. The dollar is doing pretty well, also as a haven as these trade tensions continue, and also oil starting to roll over as well, despite a few Middle Eastern tensions. Mostly in reaction to what is happening with those Iranian sanctions and how OPEC will respond. Now, if we move on to the economic calendar as we normally do, then you can see in the data behind me is that the trade fracas is still probably going to make China data important. So we'll look at that Caixin PMI. German unemployment data was what really gave markets a bit of a wobble last week. So just that idea that global growth is slowing and it's hitting typically the strongest performing economies like Germany. So from that perspective, for forward-looking data, probably US ISM data is going to be the most interesting this week. But obviously we've got NFP in terms of a look in the rearview mirror as that kind of standout US piece of data, and the ECB and how they're reacting to the likes of that weak German unemployment data. On the earnings front, a bit slower. We're not quite in any full US earnings season at the moment, but Lloyd's in the UK reporting results, and also the first set of results for Beyond Meat after one of the best IPOs in a while. Could argue that it's priced to perfection, so these earnings have to be pretty good to maintain this 260 plus or wherever it currently stands percentage price rise since the IPO for Just Meat. So now specifically onto those big events of the week, the ECB. So in terms of markets, the euro still looking pretty sluggish. It's holding above the 111 level, which is interesting just because the dollar index has just hit a one-year closing high above 98. So the dollar doing well, but just not as well against the euro. So the euro showing some relative strength, if you like. Now maybe this ECB meeting will be the one that sees the euro follow suit with the dollar. What you could perhaps argue is going on at the moment is the dollar is doing particularly well because it's benefiting from CNY weakness, China currency weakness, and the euro perhaps doing extra well because it's benefiting from sterling weakness because of all the Brexit uncertainty and Theresa May departing number 10 in the UK and the political uncertainty associated with it. Pound has been doing badly, euro perhaps a net beneficiary of that situation. Maybe the ECB change all that. I suspect they probably don't. We're in a bit of a halfway house situation at the moment because we're waiting for Mario Draghi, the ECB president, to step down. So the questions moving around about his successor, and so probably who the next president of the ECB will be is more of a bigger determination for where the euro goes than what they say at this upcoming meeting. That said, in terms of specifics for the meeting, not expecting any changes in rates, but we are expecting Teltro number 3. Hey, it didn't work the first 2 times, so let's try it for a 3rd time. Seems logical enough. The banks are struggling at the moment, mostly because of that, because of the economic difficult environment in Europe, but also exacerbated by this negative deposit rate policy from the ECB. So really, ideally, what the ECB would do at least put that deposit rate back from negative 0.4 up to 0. But they don't want to do that because that would be a sign of tightening policy at a time when the economy is weakening. So as a result, the banks continue to suffer. And there's no immediate solution because of the boundary issues in Europe, and even within national boundaries. We saw from the recent problems and potential merger with Deutsche Bank, it failed to merge with Commerzbank. The banking sector in Europe struggling a little bit, and so the ECB likely to offer some sort of accommodation here. Switching gears to non-farm payrolls, so the official expectation is 190,000. So that comes off the back of 263,000, I believe, from last month. So the trend of late has been that economists are underestimating the US jobs and overestimating the wage growth. And that looks again like it may happen this time around, because actually the wage expectation is 0.3% month over month from economists. Maybe we'll see that disappoint again at 0.1 or 0.2. So the key probably here, and we've said this for a while, is more about what the next move from the Fed will be. And because of that, we're really paying the most attention to wage growth, and the wage growth has been sluggish. So if we see another disappointing wage number, then it suggests inflation's still low, and it keeps that expectation in the market for a rate cut. If we do see a real blowout headline number, well, then that is good for the economy. And so in terms of this equity market correction that we're seeing, this rally in bond markets, the natural conclusion that you would draw would be, if the US economy looks like it's doing better than expected through these strong jobs numbers, then you don't expect the Fed to cut interest rates this year, as the market has been pricing in. The market should price that out, at least to some extent. That would mean selling bonds, and perhaps as a net result of coming out of safe havens like bonds, you'd move into riskier asset like equities. That's if we see some good data. If we see disappointing jobs and perhaps even disappointing unemployment as well, that would justify the moves we're seeing at the moment in terms of the rally in bond prices and the pullback in equities. More generally, it does look like the market, the equity market's quite fragile right now. And our expectation is that this correction has a little bit further to go. And so it remains to be seen whether perhaps this NFP report will be another trigger for that. Right, thank you very much for watching the video this week. If you enjoy these videos, please make sure to follow LCG on YouTube and social media.